What does a $5.9 million sale of a mixed-use property in Chicago's Rogers Park neighborhood tell us about the current state of multifamily and retail markets? Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. In recent news, Intera Realty has brokered the $5.9 million sale of a 42-unit apartment and retail property located at 6642 to 6652 North Clark Street in Chicago's Rogers Park neighborhood. The transaction also included an adjacent parking lot at 6654 North Clark Street. The property, which was fully occupied at the time of the sale, consists of 6 studios, 28 one-bedroom units, 2 two-bedroom apartments, and 6 retail units. This 3-story building, constructed in 1928, presents a value-add opportunity for the buyer, Imran Khan, who plans to renovate units, upgrade building systems, and reconfigure some apartments to add bedrooms. This sale highlights the ongoing interest and activity in the multifamily and retail sectors, even as markets continue to adapt to post-pandemic dynamics. The Rogers Park neighborhood in Chicago is known for its diverse community and proximity to public transportation, making it a desirable location for both residential and commercial tenants. The successful transaction reflects a broader trend in the commercial real estate market, where investors are seeking opportunities to enhance property value through strategic renovations and improvements. Looking north to Canada, regions like Kitchener-Waterloo, London, and Cambridge in Ontario are also experiencing growth in multifamily developments. These areas are seeing increased demand due to factors such as urban migration and the need for affordable housing solutions. In comparison, the Chicago market offers a glimpse of similar dynamics, where strategic investments in multifamily and retail properties can result in significant returns. As we continue to monitor these trends, it's clear that the multifamily and retail sectors remain robust and full of potential for savvy investors. Whether in Chicago or across the border in Ontario, the focus on enhancing property value through renovations and strategic upgrades is a common theme driving market activity. Stay tuned as we delve into more insights and developments in the world of commercial real estate. Roger Fields made headlines 2 years ago when he acquired an empty office tower at 550 California Street in San Francisco. At the time of purchase, the building was completely vacant, posing a significant challenge for any investor. However, Fields saw potential where others saw risk, and his strategic vision is now paying off. According to a report by Sarah Clearman from the San Francisco Business Times, Peninsula Land and Capital, the company behind the building's leasing efforts, recently announced that they have secured their 50th lease at the property. This milestone marks a near full occupancy rate, a remarkable turnaround considering the tower's empty state just 2 years prior. Fields' approach has been to revitalize the office space by targeting a diverse range of tenants, including technology firms and other innovative businesses seeking a strategic location in the heart of San Francisco. The success of this strategy highlights a broader trend in the office real estate sector, where creative leasing and redevelopment efforts are key to attracting tenants in a competitive market. The transformation of 550 California Street serves as a testament to the potential for revitalization within the office sector, even in the face of challenges such as increased remote work and changing tenant preferences. As the San Francisco office market continues to evolve, investments like these demonstrate the ongoing demand for strategically positioned office spaces. Here in Canada, particularly in regions like Kitchener-Waterloo, London, and Cambridge in Ontario, we are observing similar trends. As businesses continue to adapt to new working models, there is a growing interest in flexible office spaces that can accommodate hybrid work environments. This mirrors the dynamics seen in San Francisco, where innovative leasing strategies are becoming increasingly important. In both the Canadian and American markets, the focus on tenant-centric leasing strategies and the ability to adapt to changing market conditions are driving the revitalization of office spaces. This cross-border relevance underscores the importance of flexibility and strategic vision in navigating the evolving landscape of commercial real estate. The Canada Infrastructure Bank has successfully finalized a $50 million loan with Dream Industrial Real Estate Investment Trust to fund significant commercial building upgrades. This initiative is focused on retrofitting properties for energy efficiency and reducing emissions across 34 warehouses located in Alberta, Ontario, and Quebec. These projects are anticipated to create approximately 630 jobs and produce 14,500 megawatt hours of clean electricity through the installation of renewable power sources like solar panels. Dream Industrial REIT, part of the Dream Group of companies, was notably the first real estate group in Canada to receive a loan under the Canada Infrastructure Bank's Building Retrofits initiative back in 2022. This collaboration underscores the ongoing commitment to sustainable development within the industrial real estate sector, highlighting the role of strategic partnerships in achieving environmental goals while also bolstering economic growth through job creation and energy savings. Torino Realty has made a notable move in the industrial real estate market by expanding its presence in Queens, New York. The company has acquired a property in Long Island City for $16 million, marking a significant addition to its portfolio. This acquisition reflects Torino Realty's strategic focus on the industrial sector within the borough, underscoring the growing demand for industrial spaces in urban areas. The Long Island City property is strategically located, offering easy access to major transportation routes and hubs, which is a key factor driving demand for industrial real estate in the area. This aligns with broader trends observed in urban centers, where industrial spaces are becoming increasingly valuable due to their proximity to logistics networks and the shift in consumer behavior towards e-commerce. This acquisition is part of Torino Realty's ongoing strategy to invest in high-demand locations that offer strong growth potential. The company's interest in Queens is indicative of a larger trend, where investors are seeking opportunities in urban industrial markets to capitalize on the rising need for logistics and distribution centers. In Canada, particularly in regions like Kitchener-Waterloo, London, and Cambridge in Ontario, there is also a burgeoning interest in industrial real estate. These areas are benefiting from similar dynamics, where strategic location and access to transportation infrastructure are key drivers of demand. The cross-border relevance of this trend highlights the universal appeal of industrial investments in supporting e-commerce and logistics. By comparing the developments in Queens with those in Ontario, it's evident that the industrial real estate market is thriving on both sides of the border. Investors are recognizing the value of strategically positioned industrial properties that can serve as pivotal points in the supply chain. This trend is expected to continue as the demand for efficient and well-located industrial spaces grows. The European commercial real estate market is on track to reach a staggering $1.55 trillion United States dollars by the year 2025, and it's projected to grow even further to approximately $2.05 trillion United States dollars by 2030. This impressive growth, which reflects a 5.8% annual increase, is driven by several key factors, including improved financing conditions, renewed investor enthusiasm, and a strong focus on high-grade assets such as logistics, offices, and mixed-use properties that align with sustainability goals. This information comes from a report by Mordor Intelligence, which offers a comprehensive analysis of the trends and growth drivers within the European market. One of the most significant trends identified in the report is the return of institutional investment. Capital from pension funds, sovereign wealth pools, and insurance companies is flowing back into the European commercial real estate market. These investors are particularly interested in income-generating assets with reliable cash flows, targeting logistics hubs, green-certified offices, and mixed-use developments. The logistics and industrial properties are expanding rapidly, driven by the ongoing growth of e-commerce and global supply chain adjustments. Prime office spaces in Central European cities are also seeing renewed attention as tenants seek modern, sustainable buildings near transit hubs. This demand is boosting the office sector in core urban business districts, even as peripheral offices face challenges. The rise of environmental, social, and governance and green office standards is another critical factor, with European occupiers and investors increasingly focusing on energy-efficient, environmentally certified properties. Offices equipped with solar panels, electric vehicle charging stations, and eco-friendly design features are commanding premiums and attracting more capital. The need for hybrid and flexible workspaces is shaping corporate and small to medium enterprise demand, which accounts for around 70% of market activity. Providers of flexible office space and co-working hubs are benefiting from companies seeking adaptable leasing and smart building amenities. In terms of market segmentation, offices held roughly 32% of the market in 2024, with city center offices outperforming due to tenant preferences. The logistics and industrial segment remains the fastest growing, with a targeted compound annual growth rate of about 7.1% through 2030. While retail and hospitality face challenges, there is renewed interest within mixed-use redevelopment. The European commercial real estate market is supported by both global and local players, positioning the sector for continued progress across core segments. The report also highlights the regional dynamics, with the United Kingdom remaining the dominant national market, while Germany holds the largest share at approximately 28%. Central and Eastern Europe are experiencing the fastest regional growth, benefiting from nearshoring and infrastructure investments. Southern Europe is also drawing capital through special economic zone incentives and regional recovery efforts. These developments in Europe offer a fascinating counterpoint to what's happening here in Canada, particularly in regions like Kitchener-Waterloo, London, and Cambridge in Ontario. Just as the European market is seeing growth in logistics and sustainable office spaces, we're observing similar trends in these Canadian regions. The focus on sustainability, flexible workspaces, and strategic location is driving demand on both sides of the Atlantic, underscoring the cross-border relevance of these trends. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.